We are 1 to 2 quarters away from massive, massive, massive inflation returning to the United States of America. We go on. This from Lynn Alden. Beef prices look like a meme coin chart lately. Yes, ladies and gentlemen, this is not Bitcoin's bull run in 2017. This is not Trump's shitcoin when he got inaugurated. This is the price of high quality beef, the very nutrients that we require to be healthy as human beings. This is absolutely a cause of all the metabolic disease and obesity in America and all over the world. You guys want to know why people are continually getting unhealthier? Because they can't afford to be healthy.
There's a point in every society where the damage can no longer be hidden behind data charts, political speeches, or Fed press conferences. A point where the cost of broken monetary policy stops being an abstract economic concept and becomes something you can feel in your rent, in your groceries, in your hospital bills, and even in the air you breathe. That's the moment we're in right now. Jack Mallers argues that inflation isn't just back, it's mutating. It's no longer simply about higher prices. It's about the erosion of your time, your freedom, and your future. And unless you're paying extremely close attention, you're probably underestimating just how bad things are about to get. This is the part most people miss. Monetary policy isn't just numbers on a spreadsheet. It's a direct attack on your ability to live a stable, dignified life. When the dollar is debased, it's not Washington that pays the price. It's you. Your time becomes worth less. Your savings buy you less. Your dreams cost more. The inflation tax doesn't show up on your paycheck, but it steals from you every single day. It's the reason you work harder but feel poorer. It's why raising a family feels impossible. It's why every generation is becoming weaker, sicker, more stressed, and more financially trapped. Jack's warning is simple. The people in charge aren't trying to fix this. They're trying to survive it, and they're perfectly willing to sacrifice your future to do it. So in this video, we're going to break down Jack Mallers' full argument, why inflation is about to surge again, why the government can't stop it, and why the consequences will fall hardest on everyday people who did nothing wrong. And most importantly, how Bitcoin and other hard assets fit into this historic shift. If you care about your financial future and the future of the people you love, this is a discussion you cannot afford to skip. Make sure to like this video, subscribe to the channel, and stay with me until the end, because Jack's final point is the one nobody wants to hear, but everyone needs to understand. Thanks, and enjoy the video.
Here's my macro thesis remains the same, guys. The United States has to print an astronomical amount of money for this to work. And, listen, I'm an American, but we have a global audience here. Bitcoin's global money. All central banks and all governments have to print an astronomical amount of money to make this work. And so the way I like to think about it is inflation or insolvency, the choice America can't avoid. Okay? And the point of this is, well, actually, let me take a step back. I like the metric debt to GDP. The global debt to GDP is well over 300%. US debt to GDP is well over 100%. What do these numbers mean? Why do I like this metric? Well, here's what debt to GDP tells us. First, it tells us how much debt we're in relative to the amount of GDP is just growth. So it's how much have we borrowed from our future versus how much growth are we producing to pay that back. You understand? Because I've made the point before, governments borrowing at the size and scale in which they do, in the currency in which they can print, is the closest thing we've ever seen to time travel as a species. Why? Because, well, if money is our time and energy in an abstracted form, Elon Musk calls money a labor allocator. You get up, you go to work, you do valuable things for other people, and in return for that, you don't get food, you don't get rent, you don't get vacations, you get money. And you use money to save the value that you just created to later then exchange for the things you want. And so if money is our time and energy in an abstracted form, our labor, our effort, then a government's ability to borrow and print it means they are reaching into our future. They are traveling to our future, to the older version of us, to our kids, to our kids' kids. And they are spending that time and energy now. And the only way to make this work is if we arrive at that future with more value than we borrowed. So we need growth. You borrow from your future because it's more valuable to expend it today. If that's the case, I borrow $100, I buy $100 worth of lemonade stand equipment, and I sell 100 lemonades for $2. Successful debt, because I took on $100 worth of debt. I made $200 by selling lemonade. I pay off the debt. I'm left with $100 worth of profit. Now, debt to GDP at over 300%, at over 100%, tells us a very obvious thing. Governments around the world at over 300%, and the government in the United States at over 100%, has borrowed an incredible amount from our future, from our kids, from our grandkids. They have spent our collective time and energy already, and they have nothing to show for it. They spend it on war. They spend it on political infighting. They spend it on nothing productive. We have no growth to pay that back. And so what's their solution? Their solution is to print money. And so here we are, when they're faced with this decision. Inflation or insolvency. Either the thing goes belly up and goes bankrupt, or they have to print and they have to face inflation. And they've been juggling between these two worlds for 50 years, and this is a dead end. There's no more juggling left. Let's get into it. Okay, so let me just break down. I've showed you guys this slide before, but let me just break down. Think of the U.S. like a business, okay? And we've talked about this before. Scott Besson is our sitting CFO, so to speak. Just hang with me for the analogy. If you were to look at our books, what do we spend money on? It's a good question, right? So supposedly the United States loses $2 trillion a year. We run a $2 trillion deficit. Where is all that money going? These are our outlays. This is how we spend money. And the green is more recent than the blue. The blue is 2024, the blue is 2023, the green is 2024, and we're living through 2025. We'll get that data soon, okay? But the point is, the green bars growing faster than the blue bars means we continue to spend even more. Now, what are we spending this money on? Our biggest expense is health and human services. Our second biggest expense is Social Security. So these are government guarantees, government promises to the people. We are giving money in a this politically bullshit way. And spare me with the Social Security. All the boomers get all up in arms about their Social Security when I talk about Social Security on here. Not the point, okay? Number one, health and human services. Number two, Social Security. Number three, Treasury. What does Treasury mean? That's our interest expense. We have $38 trillion worth of debt. We borrowed that money. We borrowed that time and energy from somebody else. We borrowed that time and energy from the American people because when you go deposit your money into Chase, into Citi, into Wells Fargo, they go and lend that to the U.S. government, whether you know it or not. When you deposit into a bank, you are a lender to the U.S. We borrowed that money from hedge funds that are levered in the U.S. financial system. We borrowed that money from sovereigns and global trading partners, China, Japan, Russia, all throughout everyone. We owe interest on that debt. That debt is not free. You see? And then after that, defense. We live in this fiat war world, okay? So here are our outlays. And the most important one I want you guys to focus on is the Treasury one, is the fact that it is so expensive and is creeping up to be our largest expense is the interest on our debt, just how indebted we really are.
What Jack is laying out is the unavoidable outcome of a system that has exhausted every real option. When a government becomes dependent on debt to survive, inflation isn't a mistake, it's the policy. Bitcoin's recent volatility, the sudden pullbacks, the violent liquidations, and the rapid recoveries all mirror this reality. These aren't random market tremors. They're reactions to a global financial machine that is losing the ability to hide its cracks. When liquidity tightens, every risk asset feels it. When liquidity quietly returns, as it always must in a debt-based system, Bitcoin is the first to sniff it out. Jack's point is simple. If the money printer is the last tool left, then inflation is not a risk. It is the baseline. And this is where the crypto market enters its most misunderstood phase. While retail panics over volatility, deeply informed players understand the environment we are transitioning into. Bitcoin isn't just trading against supply and demand anymore. It's trading against global monetary failure. Every time inflation resurfaces, every time debt rolls over, every time policymakers choose the easy path instead of the necessary one, Bitcoin becomes stronger. That's why Jack draws attention to food prices, because when necessities break, the population wakes up. And when the population wakes up, they look for alternatives. So as we head into the next cycle, this isn't just another Bitcoin bull run. It's the beginning of the public finally connecting their declining quality of life to the money they're forced to use. Let's get back to the video.
Here's my point. The US, and every time I do these, I'm an American, so sometimes I can't help it, but I say the US, and then when I talk to you guys, and I know you guys aren't all from the US, I feel like shit. So, when it says US, just say fiat. The fiat system loses either way, okay? If yields go up, so yields is yields on treasuries, how much it costs for the US to borrow. Yields, interest rates, just the rate in which it costs the United States to borrow money and perpetuate this system. If the yields go up, the government goes bankrupt, right? They cannot continue to afford and pay this interest. If the yields go down, inflation explodes, okay? And this is where I'm trying to kind of showcase to you guys the seesaw that we're living through and how it's like living at two ends of the extreme. You let inflation rise, and then you have to crush inflation. When you crush inflation, it goes the other way, and then where I think we're going is yield curve control. And like Larry Lepard has written a book about the big print. So whether it's the big print, yield curve control, the point is the only way for them to get out of this is to print money to buy bonds and cap the cost for them to borrow. Basically, tell the Federal Reserve, print unlimited dollars and lend it to us. That's where I think we're going. So they're going to choose solvency over inflation. This is the choice they have to make. Are they going to burden the currency holders, burden the people, the everyday working class that's living paycheck to paycheck? They can't afford to own assets. They can't afford to buy Bitcoin because they don't have excess cash flow. They're going to choose their solvency over the best interest of the people. Now, let me show you guys. So this chart, you're looking at US commodity ETFs in gold and the CPI in black. And the point, and the green circles here, and shout out Luke Groman for putting this together. The point here is very simple. US commodity prices typically lead inflation. Okay, so the gold, if you see where the green circles are on the chart, gold usually moves first. Gold moves up and black lags a little bit, okay? And that's because there's excess demand for commodities, and then the inflation is first felt in the producers, and then the producers pass that cost on and it hits the consumers last, okay? So it initially is in the physical minerals, the physical mother nature assets that we can't print in a factory. We can't keep up with the amount of fiat that's being printed and the amount of credit that's being expanded in the world. And so commodities move first, then that price and that inflation hits the producers, and the producers can't take it anymore. They pass it to the consumers. The consumers are usually a couple quarters behind commodities. And so what we're seeing in this chart is a massive, massive, massive spike in commodity prices. And so what am I telling you? We are 1 to 2 quarters away from massive, massive, massive inflation returning to the United States of America. We go on. This from Lynn Alden. Beef prices look like a meme coin chart lately. Yes, ladies and gentlemen, this is not Bitcoin's bull run in 2017. This is not Trump's shitcoin when he got inaugurated. This is the price of high quality beef, the very nutrients that we require to be healthy as human beings, our species. By the way, let me say, because sometimes you guys like my health opinions, this is absolutely a cause of all the metabolic disease and obesity in America and all over the world. You guys want to know why people are continually getting unhealthier? Because they can't afford to be healthy. If we all were able to eat and afford organic, high quality ingredients, metabolic disease and all of our health issues would decline drastically. But it's the only thing that can keep up with the supply of printing money, of digitally hitting keystrokes and creating money out of thin air, is industrial sludge made in a factory. So you're not getting real beef, you're getting industrial sludge factory beef. And that shit is making you sick. Anyway, back to the point. Inflation. Guys, commodity prices surging, beef prices surging. Listen, I don't care what any politician tells you. They can't print cows. They can try and convince you they can and sell you beyond beef sludge garbage, but they cannot print beef. Next, data centers, and we'll get into AI at the end of this. Data centers are a gold rush for construction workers. What we're seeing, look at the red versus the blue here. The blue, average hourly earnings of all employees in construction, okay? We are seeing, and the red is market yield on U.S. Treasury securities, 10-year constant maturity. And these have an extreme correlation, okay? And my point is, inflation is back. The CPI will realize it in 1 to 2 quarters. Commodity prices through the roof. Beef prices through the roof. Construction through the roof, okay? There's a lot of spend in raw natural commodities, in raw agriculture commodities. Again, things we cannot print. They cannot keep up with the supply of fiat currency. So when you cannot find supply, you have to find a higher price. I've explained that to you guys. For anything you want in your life, with more demand comes more supply, period. If everyone wants an iPhone, Apple will make more. If everyone wants a cheeseburger, McDonald's will make more. If you can't find any more supply, you'll find a higher price. Who has the iPhone? I'll pay $2,000 for it, $4,000 for it, $8,000 for it. Who has Bitcoin? Because I can't get it out of the ground. I can't get it out of factory. So when I bought my first Bitcoin, it was under $100. Today, someone bought a Bitcoin for $90,000. Now, what if the US wants to fight this inflation that's coming? We all see it coming. Then they have to raise rates. And I know that this may be oversimplified, but again, you'll get the punchline in a second. If you want to fight inflation, you have to raise rates. But if you raise the rates, then you're insolvent. Let me go back to this. Guys, our treasury expense can't keep growing. It's already the 3rd largest expense we have. With rates this high and $38 trillion in debt, do you want to foot the bill of 4% of $38 trillion? No. I didn't think so. Neither do the American people. We can't afford it. These people have borrowed from our future, and not people make the mistake. Oh, well, they can just print the money that they owe, right? No, guys, they've borrowed our time and energy, our labor, our effort. That's why for kids my age, or young adults my age, the youth. That's why our parents, they had to save for half as long as we do to own a house. They got married much younger than we did. They had more kids than we're having. Why? Because when you borrow from our future and debase the currency, you are increasing the time and energy required to have the life that we were promised.
Jack Mallers' argument lands on a point most people sense but can't yet articulate. This isn't an inflation cycle. It's a monetary unraveling. The debt load guarantees it. The political incentives reinforce it, and the global financial architecture depends on it. Every major economy is now locked into the same feedback loop of borrowing, debasing, and pretending things are under control. But nothing is under control. Not when essentials soar, not when wages fall behind, and not when households are forced to downgrade their lives in real time. What we're witnessing is the final stage of a system that has spent decades borrowing prosperity from the future. and the bill is now arriving for everyone at once. And this is why Jack places so much emphasis on the human consequences. Inflation doesn't just reshape markets, it reshapes people. It changes what families eat, how they raise children, what opportunities they can pursue, and what options they have left. It divides society into two groups, those who can shield themselves with hard assets, and those who slowly drown under the weight of rising costs and shrinking purchasing power. When money breaks, society breaks, and the people who suffer first are always the ones with the fewest buffers. But the other side of Jack's message is just as important. The escape exists, but only for those who understand what's happening early. Bitcoin, scarce assets, and decentralized value systems aren't speculative toys anymore. They're lifeboats in a storm that policymakers have no intention of calming. As inflation pressures rebuild and the next liquidity cycle emerges, the people holding assets with real scarcity will not only survive, they will be positioned to thrive. So the choice is simple but urgent. Ignore the signals and hope the system magically repairs itself, or recognize what Jack Mallers is trying to warn everyone about. That the future belongs to those who protect their purchasing power now, not later. And drop a comment below. What part of Jack Mallers' analysis stood out to you the most? Let's talk about it, and let's get more people prepared for what's coming. If you found this breakdown useful, make sure to like the video, subscribe. Thanks for watching.